All right. Welcome. Great to have you. We'll get started here in just about a minute. Here as we're just slightly early. Hope you're having a good start to your holiday weekend. Here, market closed today, which is a rarity, but kind of nice. Kind of nice every once in a while to have a day where where the market's just not ticking overall. But anyway, hope the markets are treating you well. And I'll be back here in about 30 seconds, and we'll get rolling. All right. Good morning. Welcome. Great to have you aboard here today. My name is Jeff Yaede. I am the founder of a site called Trader Minute and the new Trader Minute Academy. These days, I'm involved in the training and the trading side of things, and allows me to focus there instead of on the business side of things. But here today, putting or giving a little bit of a look into some of the things that are going on out there in the current market environment and kind of how that applies to some of the things that are going on with Trader Minute and the Trader Minute Academy here, over the last few months. Now, the last time we had a live webinar like this, the S&P, the market was in chaos, right? And the market was in this kind of big dip stage and falling off. And we talked about what was the path of least resistance or the logical progression after something like this, and that typically it's going to take a few months for it to sort out. Once it does, we tend to return to the highs. We've seen that happen, and now that that's happened, a lot of questions are out there. Hey, what's going to happen next? What goes on next? What happens in the market? And there's a ton of opinions out there, and so we're going to go out today. We're going to look at some of those opinions. We're going to talk about how to play them, some of the setups that can be made here today with those, and then how to monetize, as the summer months kind of unfold. But to start here today, I want to go out and take a look at a sector, right? And I want to do this because we recently launched Trader Minute Academy, which is over 50 hours of live kind of market training. These aren't training videos that are PowerPointed up and bullet pointed down. No, these are training videos that took place in a live, real-time, real-ticking market with live trading going on. Right, and some of the stuff that we do in these trainings is around different sectors, being able to understand what's going on with a group of stocks, being able to say, hey, you know what, this is an area that I want to focus some of my trading in because the path of least resistance is either seriously higher or seriously lower. Which one do I kind of want to play? How do I analyze it? How do I then pick the best stocks? And we have all sorts of training on this type of thing in the academy. And today I want to kind of give you a little flavor of what some of that training is like. So we're going to go out and take a look at gold, the gold sector, what's going on in the sector, what's kind of happening in the sector, and how do we trade that sector going forward. Then we'll go out and take a look at the broader market and some of the opportunities that are there at this moment. So let's get started. Gold. Here's a chart of gold over the last 20 years, right? And very interesting chart. It's one where we can see a lot of consolidation here over the last 5 years, 5-6 years. The price of gold really hasn't gone anywhere. It's just sat there, right? We've had a couple little dips and a couple little rips, but after this monster bull market in gold from 2001 to 2011, just this absolute monster bull market, gold has taken years to consolidate its gains. Many years to consolidate the gains. Why is this important? What's going on? What's happening? This is one of the sectors that really piques my interest. I was involved in this sector heavily as a fund manager back in 2009, 2010, 2011. I was fortunate enough to, be part of the drop in gold and the drop in silver that occurred here in 2012 and 2013, and it was very good to me. But over the last few years, my trading in gold, my trading in silver has been a little more muted because we're not talking about a big trend type scenario going on. But I suspect that that's going to be changing. I want to talk about why. Over the last little while, we have seen companies in the gold miners, right? When we go out and we talk about gold, there's the yellow stuff, right? There's the yellow stuff, and there's jewelry and all that, right? And then there are the gold miners, and there's an ETF, the GDX, that tracks these gold miners. And you can play gold a variety of ways. You can buy it, you can just buy the hard gold. You can buy the gold miner stocks. You can buy, all sorts, buy coins, right? All sorts of stuff. But of late, we see gold mining companies going out and buying something. And what are they going out and buying? They're going out and buying other gold mining companies. Now, this isn't happening, if you go out and you do a search on the internet, you're going to kind of find this talk that, there's just all this merger and acquisition going on within the group, and everybody eventually is going to get bought out, and that's not going to happen. It's just not going to be the reality. But there is a group of gold miner companies that are out there buying others. And those are the larger market cap, the larger gold mining companies in the world. They're going out and they're buying other gold mining companies. What's going on? Well, Newmont, Gold Corp, Barrick Gold, Randgold. We see a big merger in South Africa. What's happening? What's kind of taking place? Well, Jason Reed, who's the CEO of Gold Resource Corporation, recently said the rapid pace and escalation of mining deals signals that companies believe the industry is moving back into a bull market in precious metals. So basically says, hey, you know what? We have this merger and acquisition activity going on. It's these companies believing a new bull market's ready to emerge. He says acquiring ounces before the bull market fully takes hold seems to be the strategy. Once the bull market is on solid ground, M&A or merger and acquisition opportunities will get expensive fast. The industry has been known to pay 2 to 3 times more for assets than they were worth during the last bull market. Many CEOs and management got fired for that not too long ago. The time to do M&A is well before the peak. Makes some interesting points. We saw a big bad bull market in gold, and we saw gold push up into these peaks here in 2010, 2011. During this time, we saw gold mining companies buying each other. What happened? Well, they were overpaying in a big way. A lot of those people, those CEOs that made those deals, they're gone. They've been ousted. They've been released. They've been replaced with CEOs and executives that have an eye on the future, not kind of getting caught up in the buzz of, what's going on. And right now, one of the things that these gold mining companies are signaling is they're signaling that, hey, a bull market's coming in gold, but we think it's coming pretty soon. Why? What about their actions says they expect it to come soon? Well, gold mining companies, they can go out and they can increase projects, right? Gold mining companies, they have reserves, right? They have production going on, and then they have reserves where, they're going to have to put some money in to ramp up the production to be able to extract the gold ore and to be able to monetize. Well, what they're saying is that, right now, the bull market might be coming too soon for us to really monetize any new projects that we start. The ramp-up time is going to take too long. So instead of going and starting new projects, which have a cost associated with it, which have some risk associated with it, let's go buy up another company that already has production going. Let's consolidate some of the assets, right? Let's kind of increase the margins for both groups through the consolidation. That way, when the bull market comes, we actually are leaner. We're actually able to drive more profit, more earnings, and our investors are happier. And we see that going on over the last 6 months, right? We see that taking place, and it's one of those things where there's a lot of opinions. Does that continue to happen? Does it not continue to happen? But I'm of the opinion that what we are seeing is a precursor to the next big move in gold. Now, before you rush out and say, well, do I buy gold tomorrow? The answer is no. You don't go buy gold tomorrow, right? One of the things with gold, if we go and we look at just some simple seasonality, right, of gold, and I'm just going to put the GLD ETF in here, you can see that May and June tend to be seasonally down periods for gold, right? March, April, May, June, not the best times to be an aggressive buyer of gold historically. Okay, so this isn't something I'm looking to say, man, right here, right now. In fact, one of the interesting things is this kind of merger and acquisition story, it has driven some of these miners up. There's been a little bit of euphoria in it, and it's starting to come on out. And we're going to see that come on out, and that's going to be the opportunity to go out and be a buyer. So what do we go and buy? Do we go buy gold, right? Do we go buy the yellow stuff? Well, the yellow stuff is going to be hostage to the U.S. dollar, right? What do I mean? Well, here's the monthly chart of gold. You can see it's been flat here since 2013, mid-2013. Hasn't really gone anywhere. Well, what about the U.S. dollar? Well, here, 2013, we had a big move up in the U.S. dollar, right? 2014, but since then, U.S. dollar really hasn't gone anywhere, and we've seen gold flat. For the most part, right? For the most part, gold is a currency, and it moves counter to the dollar. Now, from time to time, we see elements come into the market that kind of unsettle that correlation to where we can't, where we can see dollar up, gold up, or something like that. But over the long term, that's the general correlation because gold is seen as a currency, right? Now, occasionally, when we're talking about big bad bear markets, gold gets bought up as a fear trade. But it's important to note that if you're buying gold for a fear trade or buying gold to protect yourself from a rollover in equities, I mean, you can just take a look here in 2008 when stocks rolled over. Gold rolled over too, right? It's not going to be immune to, big pullbacks. It's not going to protect you from, a big market scare. Let's face it, if there's a global economic disaster, are people going to be running around the street with gold coins, to go buy stuff? No, the thing that's going to have value or things that are going to have value are not gold and silver. It's going to be actual commodities that people can use. So it's not that type of a play, right? It's not this fear play or anything like that. This is a currency. This is a commodity that has a limited kind of quantity that is out there. And it's a commodity that, let's face it, some of the exploration for it has toned down, has died down over the last few years as the market has consolidated. So if we're going to take the side of some of these CEOs and see some big kind of move coming in gold, how do we go and play it? Well, we can go and play it with the gold miners, the GDX, right? You just go buy the GDX and say, hey, you know what? I'm going to play for the gold miners to go higher. They're leaner, meaner, better than what they were. Gold prices go up. These miners are going to do very well. And you have a good point, right? You have a good point. You don't go buy them today, but, as you look over the next several months, there's going to be a nice buy opportunity that will come in, right? It'll be pretty simple to see. It'll be pretty simple to read. You could just take a look at some of the consolidation ranges that these are in. They break out of those ranges. You go and buy them. They're going up, right? And that's one way to go and play it. Some people suggest that you go out and play the gold juniors, right? They say, well, you know what? Since we're talking about merger and acquisitions in the space, go buy the smaller gold companies because they're more likely to get bought out. Makes a lot of sense, right? Makes a lot of sense until you look at it a little bit closer. Who are the companies getting bought? Who are the companies that are merging? Newmont, Goldcorp, Barrick Gold, Randgold. These are some of the bigger companies. It's not the little guys getting bought up. It's the big guys getting bought up or big guys merging, right? So, the gold juniors, not going to give you all that much exposure, to that. So for me, the best way to get just broad-based exposure, GDX. Be exposed to the GDX. Now, I would not be a buyer of it right here. Let it pull back, to about 2040, 2060, somewhere in this area. Look for it to start to rally off of this level, and there will be the opportunity to buy. But you can also look at individual companies, and there's 3 individual companies that I want to kind of turn your attention to. Number 1 is Harmony Gold, HMY, right? Now, this is a junior miner, but it's a pretty large company. It's the third largest in South America. You can see the price of the stock, $1.80. Pretty cheap, right? Pretty cheap. Well, this company has a problem right now. Well, they have 2 problems. They have one problem is the fact that they have a high debt load. Right? They have a lot of debt. That's pretty common for gold mining companies, right? Because when they go and they start projects, they have to borrow a lot of money. And you know what? It takes a long time for those projects to ramp up and for that money to get paid back. So, it's not, their high debt load, it's not something that is very unique to them. It's something that we see in almost all of these miners. But it is something where, when you see the stock go down and you hear people talk about why, they oftentimes will point to that. But the other problem for this company is they need gold to be about $1,270 an ounce to be profitable. Okay, $1,270. Where's gold right now? 1,275. They're not very profitable, are they? Right? It's just one where they're just not able to make money, right? And if we come and we look and we just pull up something like just some of their basic fundamentals, right? And we look at their income, you can see their income's pretty negative, right? They have a lot of sales, $1.7 billion in sales, but they're actually losing money on those sales. One of the reasons why it's trading below book value. Its forward PE is 6. It's super cheap, with a lot of valuation metrics. But the reason is they're losing money at these levels. So why do I show this? Well, I show this because if we are talking about a bull market in gold, the story now changes dramatically for Harmony. If gold starts to push up to $1,400 an ounce, we now have a company that's losing money. What's going to happen? They're going to be making money. They're going to be making a lot of money. They're going to go from negative earnings to positive earnings. What do we know about stocks when they go from negative earnings to positive earnings? They go up not a little bit. They go up a lot of bit. So if you're looking and you say, you know what, I'm going to wait out this kind of seasonal downturn in gold right here, and in about 2 months you look at Harmony. You look at Harmony, and you go out and say, all right, gold's moving up. I'm going to go out and take a look at Harmony. This is going to be a stock that may be about the $1.60 area, where you have the potential to be riding a stock that moves into the $6 to $8 area if gold moves into that bull market. It's a high reward with relatively little risk from just an absolute value standpoint. And one of my favorite ways to play an emerging bull market in gold. It's not something that I want to go buy and I stare at it every day and go, did it go up today? Did it go up today? No. This is going to be a long-term type of element that will come into play. But a company that could easily see 400, 500, 600% gain over the next year and a half to 2.5 years. Harmony Gold, one of my favorites. Now, there's another gold company called Yamana. Now, this, I mentioned I traded gold quite aggressively back in my fund managing days, 2010, 2011, 2012. Yamana Gold was a big one that I traded. And, it was up in the $10 area. And since then, it's come down and come down quite a bit. And it has a similar problem to Harmony, right? If we come into Harmony and we say, well, they're losing money, well, look at Yamana, right? They're losing money too. Similar sales, similar money being lost, and actually a little bit more of an expensive stock. So it's trading at half its book value, which is where a lot of these gold miners are trading. Are these buyout candidates right now? No, they're not, right? They're not. AUY, Yamana, they only need about 1,028 in terms of the price of gold to be profitable. So theoretically, they should be profitable right here. But there are other factors going on here with the company. But this is going to be a very similar story to Harmony. It's one where if you start to see gold push over that $1,300 an ounce, $1,400 an ounce, it's got that potential to be a $6, $7, $8 stock very, very quickly. But what happens more than that with Harmony and AUY is that if you start to see gold ratchet up, they now become buyout candidates, right? They go very quickly from being, hey, you know what, we can't turn a profit, to, wow, we are very attractive because of everything else going on, and these other companies can come and purchase, pick us up, and be ramping profitable production right away. So these are my two favorite to kind of be a buyer of as gold starts to move higher. Right? They're not things that say, hey, let's go buy the dip or something like that. But as gold goes higher, these are two that could be very attractive if you want exposure to some of the possible merger and acquisition. But one of the best companies out there when it comes to this story is KL, or Kirkland Lake Gold. And I think the story here with Kirkland Lake tells the story of gold miners. And if you're looking at gold miners and you want to find a gold miner that is going to move from the $2 to $10 area instead of the $2 to the 20-cent area, which a lot of gold miners do, a lot of gold miners go from $2 down to 20 cents. Kirkland is the story you're looking for. Why? Well, as Kirkland goes forward, what it's doing year over year is it's raising its production. Okay, right? They're producing more. Oh, that's nice, right? That's nice. We can find plenty of gold companies that produce more. But Kirkland's producing more and doing it in a very unique way. They're producing more with falling costs. In fact, their costs here in 2019 are projected to fall to $680 an ounce. You compare that to Harmony and AUY. I mean, it's what, 40, 50% cheaper? They're able to produce gold at a significantly cheaper level. Now, is it a little more expensive from a fundamental standpoint? It sure is. But if you're one of the big gold companies and you're one of the big gold CEOs, right? You're Barrick Gold, Newmont Mining, right? Gold Corp, being kind of thrown in all that. But if you want to go out and you want to be a buyer, who are you going to buy? Are you going to come down and buy something pretty cheap that isn't that profitable, or are you going to go buy something where the production costs are going down and the production is going up? Which one's going to add to your bottom line? Well, Kirkland Lake is going to add to your bottom line. And it's going to add to your bottom line in a big way. And more importantly, it's going to add to your bottom line immediately. So if you're looking for the next stock to get kind of taken out, the next gold miner to get kind of bought up, Kirkland Lake is one of the best candidates that is out there on the market right now. Now, if gold starts to go higher, that'll bring Yamana, that'll bring Harmony into play. But for now, Kirkland Lake is one of the tops. The other one, right above here, Agnico Eagle Mines, AEM. Now, this is an interesting company. This isn't a pure gold company. This has a lot of silver mining associated with it. But this is a company, AEM, that has production cost at about $900 an ounce. So they're producing profitably right now. Okay. But one of the biggest things going for AEM are proven reserves. You think about what it costs to send geologists out there to find gold, right? That exploration process. It's very, very costly. Are the gold mining companies going to be wanting to put a lot of money into that as it goes forward, given what happened 5, 6, 7 years ago? Or are they going to want to gobble up and buy proven reserves? If they're going to start new projects, do they want to start from scratch, or do they want to start with what they know is there? They want to start with what they know is there. That makes the Agnico Eagle attractive because it has large amounts of proven reserves that can be exploited, that can be used in the future. So if we start talking about the price of gold pushing on higher, yeah, it's going to benefit, most of these miners, maybe Kirkland Lake more than anybody. But it's one where Agnico Eagle now becomes significantly more attractive because of the proven reserves that they have. We've seen this happen over the years in oil companies, where oil companies that maybe aren't producing a whole bunch, but they have a lot of proven reserves that they own. They get gobbled up for those proven reserves, and now the bigger company gobbles up the smaller company and then starts to drill. And that same element could happen here, or I would be very surprised if it doesn't happen here with Agnico Eagle. So these are some of the favorites, here in the space. Again, I don't think they're worth buying today. Right? I don't think they're worth buying today. Do your homework, take a look at them over the next little bit, maybe start to wade into a position. But as we go into the second half of this year, I think we're going to be talking about a very game-changing story here with gold. Now, a little while ago, a couple months ago, we talked about this story with gold and broke it down a little bit more. And this is one of the things that you'll see in the Trader Minute Academy. Trainings like this, analysis of sectors, what stocks, how to break things down, and then how to be able to do it yourself. And, in here, there are videos. In fact, I'll scroll on down. You'll see, let's see, where is it at? Yeah, multi-year bull market in gold. Is that starting to emerge, talking about the pros, cons, how to play it. You'll see these types of things in the academy. Now, what you'll also see is you'll see, complete training on charting, technical analysis, how to build watch list, how to trade options, how to do, a basic or more advanced fundamental analysis, how to interpret the market. But maybe one of the best videos in here is what is the market vibe? And why do I bring that up? Well, because one of the other things that we've added to the academy is this market vibe indicator. Several years ago, I was approached by a client who said, Jeff, I like to trade. I trade a little bit here and there, and, it's fun. But what I really need is I have my retirement funds, and I held them through the big downturn 2007, 2008. I missed a little bit of 2009, got back in, rode the European crisis, the big ups, the big downs. I've held a large amount of money in my retirement for a long time, and every time we have a downturn, the stress, the uncertainty is very high. What I would love is something that could take that out. Meaning, I need something to just be simple and tell me, look, Now is the time to go to cash. And now is the time to put that cash to work. That's worth way more to me than any kind of small short-term, trade with 1,000 here and there. And it was a very interesting conversation because it brought me back to something I used in my fund managing days, where we kind of had we had a computer, and on it, on the monitor, were about 6 different indicators that were pretty market-driven type indicators, and we used them to understand what's the market environment. Is this an environment to start getting more aggressive to the upside, more aggressive to the downside, to start trimming exposure, adding exposure? And as I thought about that and how we used it and this gentleman's issue and what he was looking for, kind of went back and said, all right, we're going to put this together. And we're going to create an indicator out there. And you know what? There are other market indicators out there to tell you, well, is the market going to go up or down? But we're going to create one that tells you, look, right now, does this market have much greater potential of going higher, lower, or just flat going forward? Not hindsight, not backwards, but going forward. And we developed an algorithm, and that algorithm we put together in this package called the MarketVibe. And the MarketVibe has been running live since September in 2015. And the MarketVibe is a very simple indicator. About an hour before the close each and every day, it goes out and it runs the algorithm, looks at where various things are, and says, okay, is it bullish, neutral, or bearish? It has a signal on it. It'll give a number, right? It'll give a number between minus 10 and 10. And you know what? Sometimes a 5 can be bearish. Sometimes it can be bullish. Sometimes it can be neutral. But overall, it will give a number to show you kind of who owns most of the metrics. And it'll give you a signal saying, hey, what's more likely to happen going forward? Flat, up, or down? And the performance has been outstanding. Here in 2015, when we rolled it out in September, you can see down here below, bullish. There were 27 bullish days. There were 31 bearish days. On the bullish days, the average or the total gains were 8%. On the bearish days, the total gains were minus 5%. That's what we want to see, right? Bearish days down, bullish days up. Every single year since the inception of this indicator, the bullish days have had a total daily gain, a strong double-digit total daily gain, while the bearish days have shown a loss. The neutral days have always been right smack in the middle, right? Here in 2018, neutral, when the market was, or when the MarketVibe was neutral, it tended to go down, and when it was bearish, it went down even more. On the bullish days, that's where all the gains were here in 2018. You can see here in 2019, the neutral days have had a little bit of gain, right? The market's up 2.75% on the neutral days. On the bearish days, even though there's only been 5, market's been down, right? I think maybe the market's only gone down 5 days the entire year. At least it seems like it, right? But on aggregate, you can see here since 2015, what happens after these signals? There have been 420 bullish, 67% gain, outperforming the market significantly. But what's even better is that all you have to be in the market from an upside standpoint, in the case of this gentleman, is all you have to be in is during the bullish days. The rest, you just sit on out. You don't have to worry about it. You can just kind of sit out. You're only in half the time, and you're making many more. You're increasing your performance over the overall market significantly. So your risk factor goes down dramatically, your reward factor goes up dramatically, and it's a very simple read once a day. And this isn't something that's changing all that often, right? The signal doesn't change, very often. Right now we're in about a month of neutral, right? We had 2 bearish days here. We came down to another bearish day, then snuck up into neutral. Here's the bullish period from, the beginning of the year here to middle of or beginning of March, right? Every single day bullish. Yeah, I know market was overbought and all this and this nervousness about China and this and that and the other. But hey, the indicator kind of, doesn't take any of that into account. It takes into account what professionals are doing, takes into account what the market internals are doing, and it looks at what is the path of least resistance going forward. It's one of the best indicators in terms of being able to understand the market and being able to trade the market out there. So when I get asked, okay, Jeff, the current market right now, man, what's it going to do? It's high. It's back to its highs. We have trade war with China. We have earnings upcoming. We have people calling for a big collapse. We have people calling for a big rally. We have all of these opinions out there. They're a dime a dozen. They're all over the place. What do you subscribe to? Well, I understand what could happen. I understand that there could be a significant downturn. I see the negative divergence of things like the momentum oscillators out there. I see some of the lack of volume and conviction in the upside. I see some of the revenue of companies starting to turn down. And when I look at other times in history where we've seen these things, we've seen the market fall dramatically afterwards. But I also see a few catalysts for potential growth. And if we see a market that grows, something, could change here to the upside. And that potential is out there. This week, Honeywell, a big industrial company, global industrial company, came out with their earnings. And their CEO said something very interesting. He said, we're looking for merger and acquisition opportunities. We're looking to buy up other industrial companies. But right now, we're struggling to place a valuation on many of these companies because of the current market environment. And I kind of chuckled to myself. And I said, well, the whole market's struggling with that, right? It's looking and going, we can even go look at Honeywell itself, and it's at record valuations. It's way overvalued from a historical standpoint. But if there's economic growth, it's actually undervalued if you factor in growth. So the market's struggling right now to understand where some of these valuations are. It's not a cheap market anymore. But it's also not an expensive market if there's growth going forward. And obviously, very few people have a crystal ball. And so what do you do? How do you react? How do you play that? For me, it's very simple, right? Right now, from just an overall market index exposure level, I don't have it, right? I just not much to do. I know what happens when it's neutral. When it's neutral, there have been 326 neutral days. The average daily gain on the market on those days is 0.01%. Means market just doesn't really move. So why be in? Why take the risk? When it triggers bearish, average daily loss is 0.22. All right. When the MarketVibe triggers bearish, all right, market puts, let's go. If it turns bullish, average daily gain, 0.16 to the upside. All right, time to play calls. Time to go. Time to play to the upside when the MarketVibe turns bullish. Until then, I can filter out all the noise. I can filter out all the debate. I don't have to worry about it because I know what's going to happen. Well, over the long haul, nothing. Just absolutely nothing. It's going to be pretty stagnant. It's going to be pretty flat, here overall. And so one of the best indicators to kind of understand, and one of the things that, we put in here, especially for new traders, but something that, can be used from a retirement exposure account, from a stock trading account, and new traders to kind of understand, okay, what type of environment do I step in? If you're a new trader, and let's just say you're new to options, and you want to trade options, you want to trade them, up and down, right? Is the best environment to buy options a neutral environment? No, things don't move enough. In a bearish and a bullish environment, that's when options become really special. That's when they really get their move on, right? But in this neutral environment, not so much. And the details and some of the a little more insight, more understanding of how this MarketVibe works and how this number is driven and how this signal is derived, is here in the Academy training where I showed before, down here into this kind of what is the MarketVibe and really kind of how to use it. Now, those of you who know me, you know that I trade stocks, I trade options, I do it personally. I love options. I love trading options. But I also understand there's a big risk in options. And if you come into the academy, a lot of live trainings on options, how to price options, the basics on options, how to get the leverage with them, how to set up different types of option plays, how to hedge using options. But when it comes down to options, for me, it's all about risk reward and this mentality of risk reward. And it's something where, I run, on Trader Minute, a 100K challenge where, about every 4 months, put $3,000 into play to say, hey, you know what, let's take advantage of some of the short-term opportunities that are out there and see if we can monetize that aggressively, right? But just with a very limited amount of capital. This isn't something where we take a $500,000 retirement account and say, can we turn this into $1 million? No, no. There's too much risk there, right? Too much risk there. We take a small amount and say, let's go. Can we get hot? Can we get rolling? And use some of these mechanics in the market, to step in and get rolling. And as a new trader goes out and starts trading, or an old trader, gets involved in the option market, right? You don't have to follow somebody else's trades. You don't have to do somebody else's trades. But you need a philosophy. You need a mentality. You need a way to go about it to control your risk, to be a trader instead of a gambler. And here in the academy, you get all you need to know about the 100K challenge philosophy, how it works, how the trades work, and how the mentality of the challenge works, so that you can go out. You can not only learn how to trade, not only learn how to pick stocks, not only learn how to apply options to those stocks, but then be able to take it and put it in a context to say, all right, I want to trade with some minimal risk, but I still want some of the upside potential. How do I go out and do that effectively? And that is all in here in the Trader Minute Academy. All right. Now for this weekend. Right, for this weekend, the academy is the academy. You come and get access to it. It's very easy. It's just a one-time, lifetime access. You get all the trainings. You get the MarketVibe. You get the 100K challenge philosophy in there. You get all new videos that get uploaded. We do from time to time, real-time stuff on the market. What's going on out there? You get access to all of that for a one-time fee. But this weekend, right? If you go out and sign up, what you will get emailed a coupon code. That coupon code will give you access to Trader Minute in a live 100K challenge, where I go out and do a challenge live. All the trades are sent out, talk about all the trades, and kind of trade with that philosophy, where you can go and you can watch. You can see how that goes. You don't have to trade it. You can trade it if you want. You don't have to, but where you can see that mentality. And so what you will do, you will get a coupon code that will give you access to the next challenge that will be kicking off here in the next couple weeks. So, you will get that on top this weekend if you sign up, over the course of this weekend. Okay. I hope that today was able to give you something to kind of take a look at, to go out, to be able to go out, to be able to monetize some of the stuff that's going on out there in the market, give you something to go and look for, give you something at least for the market to be able to say, hey, you know what? All right, I don't necessarily have to be in big right here. I can wait for the next move, to start to emerge, wait for that market vibe to move bullish, or wait for that market vibe to move bearish as things kind of flow in the market. And most of all, I wish you great trading success, and, it's a lot of fun. And so when you're making money, when you're having fun, it's extremely rewarding. I wish you the best. Have yourselves a fantastic weekend, and thanks for joining us today. Take care.